Do we have a little more clarity today than we did, let's say, Thursday or even on Friday?
Perhaps a little bit more clarity. I think people are probably waiting to see the text of the agreement to really understand what's going on. What I've noticed looking at the bond market is the reaction yields are lower today, probably less so than I would have expected given the move in oil. And I think some of that has to do with the other event risks that are coming up this week, particularly the Fed. So if you were just to look at the level of oil and try to map what the 10-year yield should be based on the relationship since the start of the war, the 10-year yield should probably be closer to 420, 430 than 440. But as we know, since the war, a lot of things have happened. We've had better labor market data. We've had the hotter CPI as a result of higher energy prices. And as a result, you've had higher real yields. And, there is still an event risk to get through here, which is, I think, why, the rally in 10-year across the Treasury curve today is maybe a little bit more muted than what you would have expected, given that we have reached this deal.
Well, that said, we also got inflation data last week that might have cheered investors just a little bit. It could have been hotter, right? We didn't see that much of a pass-through from oil gains, for example, or the war, if you like. Does that take the pressure off Kevin Warsh, or is he still looking at potentially wanting to convince people that a hike is necessary at some point?
So I think that this meeting has really come together for him. Our expectation is that he's going to be able to keep the committee fairly in line. In fact, for the first time in a while, we may have no dissenters because I think the committee has already really coalesced around a consensus, which is the Fed needs to stay on hold and we need to remove the easing bias within the statement. If they do those two things, I think really most of the FOMC right now is on the same page.